TD Securities has issued a stark warning to energy markets. The world is heading for deep crude oil supply deficits this summer, and a potential diplomatic resolution in the Strait of Hormuz may not be enough to prevent them. The analysis suggests that even if tensions ease and Iranian oil flows more freely, structural supply constraints will keep the market tight through the peak demand season. This is not just about geopolitical tensions, it's about a fundamental imbalance that is already in motion. The fundamental drivers of the deficit are already locked in. OPEC plus production cuts, combined with robust global demand, particularly from Asia and the United States, are drawing down commercial inventories at a pace faster than seasonal norms. TD Securities models indicate that the deficit could exceed 1.5 million barrels per day by July, even under a scenario where Iranian exports increase by 500,000 BPD following a negotiated framework. That's a significant number, and it suggests that even a successful Hormuz deal would only provide a partial solution. The report from TD Securities argues that the market is pricing in a relatively benign outcome for Hormuz, but the structural deficit is much deeper than many realize. A deal would provide temporary relief, but it would not solve the underlying imbalance. This is important because the market's current pricing may not fully reflect the true risk of it. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Deepening supply deficit. If the market is underestimating the severity of the situation, then crude prices could face upward pressure as the summer progresses. The Strait of Hormuz remains a critical choke point, through which roughly 20% of the world's oil passes. While diplomatic channels between the US and Iran have shown signs of activity, any agreement remains fragile and implementation timelines are uncertain. TD Securities argues that the risk premium embedded in crude prices will persist until there is verifiable evidence of increased supply hitting the market. Even in the event of a successful deal, the time required to ramp up production, secure tanker capacity, and move oil from the region is a limiting factor. The key point is that the market is already in a deficit situation, and a Hormuz deal may not be enough to reverse it. The structural constraints, such as OPEC plus production cuts and limited spare capacity, are already limiting the ability of the market to respond to rising demand. This is not just a short-term issue, it's a seasonal one that could have lasting implications for crude prices. The stakes are high because this summer is shaping up to be a critical test for oil markets. If the deficit persists and demand continues to rise, then crude prices could face sustained upward pressure. This is especially true if the market is caught off guard by a deeper-than-expected deficit. The risk is that the market may not be fully prepared for the scale of the imbalance that is already in place. The uncertainty lies in the timing and effectiveness of any Hormuz deal. Even if a deal is reached, it may not translate into immediate increases in Iranian oil exports. The market will be watching closely for signs of increased supply hitting the market. Until then, the risk premium will remain embedded in crude prices, and the deficit will continue to widen. The next signal to watch is whether Iranian oil flows actually increase in the coming weeks. If the market sees a meaningful rise in Iranian, most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Exports, then the risk premium may start to unwind. However, if the increase is limited or delayed, then the deficit could persist, and crude prices could face further upward pressure. The market will also be watching for any changes in OPEC plus production policies and how global demand evolves in the coming months. In summary, oil markets are facing a deep summer deficit that may not be resolved even with a Hormuz deal. The fundamental drivers of the deficit are already in place, and the market is underestimating the severity of the situation. The next signal to watch is whether Iranian oil flows increase and how the market responds to the evolving supply-demand imbalance.